This is an instructional video for comparing and contrasting two important mortgage documents called the loan estimate and closing disclosure. This is the second part of a two-part series. The first video is linked in the description if you want more general information about these two documents. Pictured are the first pages of the loan estimate and closing disclosure. The loan estimate pages will be on the left and the closing disclosure pages on the right. A loan estimate has 3 total pages and a closing disclosure has 5 total pages. As a disclaimer, and for regulatory and compliance reasons, all numbers presented are solely for illustrative and educational purposes. For the sales price, I used the data from the St. Louis Fed about the median home sales price in the United States, which is around $416,000. For the rate used, I used the Google result for the national average, which is somewhere around 8.5% as of the recording of this video. The example presented will be for a 5% down conventional loan that will require mortgage insurance. There is also a lender credit of $4,000 and seller assistance of $2,000. I am estimating $100 a month for homeowners insurance and $400 a month for property taxes. Since page 1 of both documents is so similar, the same general information applies to both pages. The upper left corner of both documents will have the when, who, where, and sales price information. You should recognize your biographic information here. If it's not your name or property address, chances are you've got someone else's estimate or disclosure. The upper right corner lists the loan term, the purpose, meaning whether it is a purchase or a refinance. Then it lists the product type. In this case, it is a fixed loan, but it also could be an adjustable loan. For the loan type, this one happens to be a conventional estimate. The loan ID is just the loan number, which the lender creates when your loan is registered. And the rate lock tells you whether the rate is locked in yet or not. If the rate is floated and not yet locked, the no box will be checked as it is here. Moving down to the loan terms, the loan amount is the amount you are borrowing, and the box to the right tells you the amount will not increase after closing. The interest rate, as mentioned, is just the national average as of this recording, and since it is fixed in this example, it cannot increase. The monthly principal and interest is part of the monthly payment. It cannot increase after closing in this example. The next 2 rows are for if the loan has a prepayment penalty, which isn't common these days, but they still exist, and if the loan has a balloon payment feature. The answer is no for both of these for this loan. If either of these say yes on your loan, that is uncommon. You may want to research that further. The next section shows the projected payments. The principal and interest just carries down from up above. The mortgage insurance in this case is because this is a 5% down conventional loan estimate. Mortgage insurance is a payment that a borrower makes that protects the lender in the case the borrower were to default. It does not protect the borrower. And mortgage insurance goes by your credit score. So the worse your credit score, the more you pay. The mortgage insurance is a payment that stays with the loan until the loan to value reaches 80%. In this example, the loan to value ratio would be starting out at 95% because you're putting 5% down. Once the balance was paid down 15% or the property appreciates, the mortgage insurance could potentially be removed. Keep in mind for most government loans, mortgage insurance stays for the life of the loan, but since we're talking about a conventional loan, that can be removed. The estimated escrow amount includes property taxes and insurance added together. In this example, $100 is estimated monthly for the homeowner's insurance and $400 monthly for the property taxes, for that total of $500. Shows that breakdown below. You'll notice the total estimated payment on the closing disclosure on the right also includes cents, just showing how it gets down to a finer level of detail than the high-level loan estimate on the left. Down near the bottom of the page are the costs at closing. This includes prepaid items like homeowners insurance and property taxes. The details show loan cost, other cost, and lender credits, and mention more details will be on page 2. The estimated cash to close is the total amount estimated out of pocket for a borrower. The loan estimate shows a higher amount because it does not reflect items paid outside of closing. And as we'll see on later pages, the appraisal is paid outside of closing in this example. Page 2 is where the two documents start to look a little different. Remember, loan estimate on the left, high level, closing disclosure on the right, detailed. Looking first at the loan estimate, it's organized by letters for the headings, and the main headings up above that are loan costs, other costs, and calculating cash to close. Starting with loan costs, Section A shows origination charges. The loan origination fee is the fee that would go to the mortgage broker in this example, and the underwriting fee is what the lender charges to underwrite the loan. Section B is services the borrower cannot shop for. The lender does these on behalf of the borrower with their approved vendors for the appraisal, credit report, and flood cert in this example. Section C is for the title or settlement company the borrower chooses. On the loan estimate, the lender may just pick a title company for the initial disclosures, but the closing disclosure will list the company the borrower actually chose. So just because a company is listed on the loan estimate does not mean that the borrower has to go with them for the title work and closing. Section D lists the total loan cost, which is the sum of A, B, and C. Then over to other costs, Section E taxes and government fees are for the recording fees as well as the transfer tax. These are standardized by the purchase price in Pennsylvania for transfer tax and the number of pages for the mortgage and deed for the recording fees. Other states may have different rules. Section F is prepaids, which includes homeowners insurance for a year, mortgage insurance in some cases, and prepaid interest and property taxes. Section G shows the initial escrow payment at closing. If you are putting down less than 20%, most lenders require you to escrow the taxes and insurance. The lender will pay your taxes and insurance from the escrow account when they are due, and they are required to pay at the discount rate if that's applicable in your state, and earliest due date. If you do not want to escrow, most lenders charge a fee for the privilege of you managing the payments by yourself if you put down more than 20%. Section H is for other items, sometimes optional like a home inspection or owner's title insurance. Section I is total other costs added up, and Section J is the total closing cost. The first line shows Section D and I added together, and then in this example, a lender credit would actually reduce the total closing costs. In this example, the borrower is getting a lender credit of $4,000 to offset some of the closing costs. In the calculating cash to close section, the total closing cost plus the down payment required for this loan program minus $2,000 seller assistance in this example gives the total estimated cash to close. Looking now at the closing disclosure, overall it is really similar in format to the loan estimate, just more vertically organized. Page 2 also has sections A through J, but they include additional columns to reflect which things the buyer is paying, which sides the seller is paying, and if there is an other party, such as a realtor or lender, paying anything. This document also shows if those items have been paid already. The closing disclosure also includes any cents, whereas the loan estimate only reflects whole dollars. Page 3 is the final page for the loan estimate, and for the closing disclosure, it is the summary of transactions for the buyer and seller. Looking first at the loan estimate, the lender information will be at the top left, and on the top right will be the broker information if applicable. The Comparisons tab allows you to compare to other loan estimates. The In 5 Years section shows the total you will have paid in principal, interest, mortgage insurance, and loan costs. The $17,823 in this example is how much principal you would have paid off for the loan in that 5 years. APR, meaning annual percentage rate, is not your interest rate. It is the interest rate plus the cost to obtain the loan expressed as a rate. APR is not a perfect measure by any means, as those lender credits and seller credits that I discussed previously do not reduce the APR even though they offset some of the costs. The total interest percentage is if you made every payment as scheduled, this would be the total you would pay over the loan term. Finally, other considerations are informational. Most lenders will require an appraisal. If you are eligible for an appraisal waiver, the lender will still disclose the potential fee since that waiver could change before closing. Assumption of a loan means someone else could potentially assume it from you. This is less common. Lenders will require you to have and maintain homeowners insurance to protect their interest in the property, and they will require that the policy meet their standards before closing. If you are late on a mortgage payment and exceed the grace period outlined, there is typically a late fee as they outline here. Loan acceptance is telling you you are not bound to accept this loan because you received the estimate or signed a loan application. The refinancing warning is just telling you there are a lot of variables that could change between now and refinancing in both your employment and the property that could impact your ability to refinance. And finally, in regards to servicing, some lenders retain servicing rights and others sell the servicing rights. So even if your loan or servicing rights were sold, the loan terms will still remain the same. Just the entity you make your payments to could change. Page 3 of the closing disclosure is a slightly different format. It has a chart at the top for calculating the cash to close. It starts with a breakdown of key items and whether they changed from the initial loan estimate to the final closing disclosure. And if it did change, it'll say yes over in the right column. Usually, if there are costs that increase, that would be a bad surprise, so lenders tend to over-disclose on the loan estimate. And if there are any unexpected cost changes, the lender will typically redisclose those through a loan estimate. The Summaries of Transactions section shows the cost and credits for both the buyer and seller. This example is really simplified, but your document will contain numbers for more of these items. Page 4 only has one main heading, and it is about loan disclosures. This section has things that may or may not apply to your loan, and there are checkboxes for anything that is applicable or not. This section covers assumption by another person, a demand feature if there could be required early repayment, late payment information, a warning about negative amortization, the partial payments policy of the lender, and a disclaimer that the lender now has a security interest in the property. There is also information regarding your escrow account. Keep in mind the amount you pay towards the escrow portion will most likely increase over time, since property taxes and insurance costs usually increase over time. Page 5 includes 4 main headings: loan calculation, other disclosures, contact information, and confirm receipt. The loan calculation section shows you the total of all of the payments if you make them as scheduled. The finance chart shows how much the financing of the loan cost you over the entire loan. The amount financed is the amount you are borrowing. The APR, as discussed previously, is your costs over the loan term in a rate form. The total interest percentage is the total amount you will pay as a percentage of your loan amount. The Other Disclosures section lists situations that could potentially apply to you, including appraisal, contract details, liability after foreclosure, refinancing, and tax deductions. The Contact Information section has the contact details of everyone associated with your transaction, including their license information. And finally, the Confirm Receipt Signature section is confirming that you have received the form. You are not accepting the loan by signing or receiving this form. We hope you found this guide helpful. If you have any follow-up questions or comments, please let us know.